Namaste FRM candidates. In 2024, there has been a significant change in the FRM curriculum, particularly the FRM Part 2 curriculum, because in FRM Part 1, the number of changes is negligible. So in this video, we're going to discuss the changes which have taken place in FRM Part 2 in 2024 versus 2023. So let's start with the first module, which is market risk. So there is no change in the content in market risk. Only one learning objective has been added in the 7th chapter, MR7, which is correlation basics, definitions, application, and terminology. So what learning objective has been added? Describe how correlation impacts the price of quanto options as well as other multi-asset exotic options. As I said, there has been no change in the content because earlier in MR7, we had already discussed the fundamental aspects of correlation and its significance in pricing complex financial derivatives like exotic options. So there was a subheading, if you remember, trading and correlation, where we explored multi-asset options known as rainbow options or mountain range options. We explored them in the context of correlation between various assets. Moreover, we also discussed quanto options and we discussed how the correlation between the index value and the FX value was influencing the price of these options. Example was also presented, right? Which illustrated how the changes in correlation are impacting the price of that quanto option and the relationship between the correlation as well as option valuation was discussed. So let's come to the next module, which is credit risk. So speaking of credit risk, there has been a major overhaul and they have tried to make it more structured and concise as compared to the previous 2023 curriculum. As far as number of chapters are concerned, the total number of increase in the chapters have been 5. So basically there were 18 chapters in 2023 and now we have 23 chapters in 2024. So it is very, very important that you refer to the new curriculum. Although the number of chapters have increased, but there is an interesting observation regarding number of pages, which we'll discuss in a while. So first, let's look at the list of deleted chapters. So the first chapter, credit decision, has been deleted. Then you have credit analyst, CR2. Then rating assignment methodologies, credit risks and credit derivatives has been deleted. Spread risk and default intensity models has been deleted. Credit transfer markets and their implications has been deleted. And finally, the understanding the securitization of subprime mortgage credit has been deleted. So in total, 7 chapters have been deleted. Now let us come to the list of newly added chapters. We have first chapter as fundamentals of credit risk, then governance, then credit risk management. Now it might seem that these first 3 chapters are kind of, filling in for the first couple of chapters which have been deleted, but that is not the case exactly. Okay, because the learning objectives have been scattered here and there. So you'll find some of the learning objectives of maybe the old CR2 in a later chapter. So overall, the foundational part has been covered in the new chapters also in the first 3-4 chapters. But it's not necessary that all the learning objectives of the previous CR1, 2, 3 chapters have been mapped in the new chapters. We'll see the mapping also of the learning objectives as much as possible. So how the old learning objectives reflect in some places in the new learning objectives and the new chapters. Then we have CR5, Introduction to Credit Risk Modeling. This is a very interesting and important chapter. Then you have credit scoring and rating. Now, earlier there was a chapter on credit scoring. Now, this chapter CR6 has been introduced and it is just before that chapter, the chapter which is already there on credit scoring. Then you have country risk, determinants, measures, and implications. So this CR8 chapter mainly is derived from, if you see the learning objectives, you'll be able to relate it from the FRM Part 1 curriculum, where we had a very similar chapter. In fact, the chapter having the same name in valuation and risk models. Then we have CR9, estimating default probabilities, then credit VAR, then credit risk, and then you have 2 chapters, one on credit derivatives and the other on derivatives. So there is a lot of foundational concepts that have been covered on derivatives and on credit risk before we move on to the later chapters. And then we have the last chapter, which is central clearing. Again, this is also a chapter which you'll be able to relate it from one of the chapters in part one in the financial markets and products module. I think it was exchanges and OTC markets. Okay, so let us see the list of reordered chapters also. So there are some chapters which have been reordered. So these chapters have been retained from the previous year, but they have been reordered. Most of them have been moved a little bit towards the later half of the course. For example, if you see structured credit risk and some other related chapters, netting also, all these have been moved to the later half of the credit risk module so that the foundational aspects are covered first. And as I said, this is an attempt to make the syllabus more structured and more sequentially sound, I'll say. So we have CR4, which was earlier CR3, capital structure in banks. Then, as I told you previously only, that a new chapter has been introduced on credit scoring. But there was already another chapter on credit scoring, which was credit scoring and retail credit risk management. So this has been now shifted to CR7, just after the new credit scoring CR6 chapter, this one which I was talking about over here. So this, yeah, CR6, credit scoring and rating. So actually, this is a very good idea, so that if you have a basic understanding of credit scoring and rating, then you will be in a better position to understand credit scoring and retail credit risk management as well. So these chapters are logical extensions of, you can say the CR7 chapter is just a logical extension of CR6. Then we have CR11, portfolio credit risk, which was earlier CR7. So it has been shifted 4 chapters ahead. Then you have counterparty risk and beyond, which was earlier CR9. Now it has been shifted to CR15. Then netting, closeout, and related aspects has been shifted to CR16. Margin and settlement, CR17, future value and exposure. So all these chapters have been moved ahead, as I mentioned, in the later half of the CR modules, credit risk module. Then CVA, also one of the very important chapters. In fact, there are some other chapters before CR20 where CVA has already been introduced. So again, this will give you a good idea. I mean, if you study the CR20 chapter after the chapter where CVA has already been introduced, you will already be acquainted with the concept of CVA before delving into this chapter, so that you can understand the dynamics and the details of CVA and its application part as well. Then you have CR21, the evolution of stress testing counterparty exposure. Structured credit risk, as I told you, it has been moved from CR8 to now CR22. And finally, the last chapter, which is an introduction to securitization, which was earlier CR17, it is now CR23. Now, as I told you that although the number of chapters have increased, but the number of pages have reduced. In fact, they have reduced significantly by approximately 50 pages. So it means there is good news in terms of the volume of the content. So don't need to be intimidated by the number of chapters. Focus on the positive side. The total volume of the course in terms of the credit risk module has actually shortened, and 50 pages is significant. So it actually indicates that they are trying to give you a more detailed and nuanced explanation of different aspects of credit risk. Since the chapters have increased, so they are trying to incorporate some new risk factors. Modeling chapter has been introduced, updated modeling techniques, and some new or specific risks to specific industries or financial products have been comprehensively covered with the addition of these new chapters. And the reduction in the number of pages, you can definitely assume that the information will now be presented in a more concise and a more streamlined manner, because this was one of the concerns of many FRM Part 2 candidates, that there was a lot of information in credit risk, which from the point of view of the exam, from the point of view of the learning objectives, it was not very relevant. I'm not saying from the point of view of understanding credit risk. Of course, it was relevant from the point of view of understanding credit risk also. But from the point of view of the FRM Part 2 exam specifically, there was a lot of information which was there, which was not very relevant. So it's good news that they have tried to present the information in a more concise manner. Organization has been better, probably. I'm using the word probably over here because once I went through the curriculum completely, I feel that there is still a lot of scope for improvement, especially in the terms of redundancy. Anyways, let's focus on the positive side. So communication of concepts is, I think, clearer, and at least to some extent, redundant information or less relevant content has been eliminated to some extent. I think sequencing also has improved. As I mentioned, that there are some chapters, for example, credit scoring has been introduced first before retail credit risk management. Then credit derivatives, there is a comprehensive coverage of derivatives, credit derivatives, all these concepts before you dive into structured credit risk and all the settling margin, collateral, all these concepts. Before you cover them, you should have a good background of credit derivatives, credit risk properly. So sequencing is better, conceptual flow will be better, and you'll be able to build on the foundational concepts before moving to more complex topics. So you'll be able to understand the interconnected topics in a better way. Now let's move on to the learning objectives which have been added or modified. So we'll not discuss those learning objectives which have been retained without any modification. Only new learning objectives we'll discuss, and whatever has modification has been there, we'll just discuss in very brief. So let's start with the first chapter, fundamentals of credit risk. So this is the first learning objective: define credit risk and explain how it arises using examples. Now we have also tried to map the old learning objectives, as I mentioned earlier, as much as possible. There are some of the learning objectives, and this is very important. I think this will be very significant for those candidates who are retaking the exam. They might have studied using the 2023 curriculum. So the good news for them is that there are many learning objectives in spite of the addition of new chapters, which you are already aware of. Okay, it doesn't mean that you don't have to cover them again using the new curriculum. Of course, you have to, but you should be more comfortable as compared to someone who's doing it for the first time. Then the second learning objective, explain the distinctions between insolvency, default, and bankruptcy. It was partly there in old CR1 because you can see that the learning objective is more or less, except for the word default. In fact, default and bankruptcy, bank failure and bank insolvency has been compared. So it's partly similar. Then identify and describe transactions that generate credit risk, and then fourth one is entities that are exposed to credit risk. So it is quite similar to one of the learning objectives which was there in CR1 earlier, where we compared the credit analysis of consumers, corporations, financial institutions, and sovereigns. Then motivations for managing and taking on credit risk. Then you have a chapter on governance. So most of the learning objectives are new because if you remember, governance was mostly discussed in the context of operational risk till the 2023 curriculum. In this chapter, separate focus is there on governance of credit risk also, which I think is very important from the industry point of view. So these are the learning objectives in governance, mostly new, not related to anything which was there in 2023. Then the third chapter, credit risk management. So the first few learning objectives, they are quite similar. In fact, all of them are quite similar: loan loss provisions, loan loss reserves. And for the candidates who want to have a documented version of this, we'll actually upload the PDF file also, so that you can go through all the learning objectives which have changed in detail. And again, I'm saying this will be very relevant, especially for those candidates who are retaking the exam, right? Because if you want a list of all the learning objectives, it's already available in the GARP learning objectives guide, right? And components of expected loss, distinguish between expected, unexpected loss. This was also one of the learning objectives which has been covered in part 1 as well, the last one. Finally, we have requirements under IFRS 9 and the procedure for loss assets and the approaches which are used to manage loss assets. Then the last learning objectives, second last in fact, components of credit risk analysis. This was also there in the old CR1 chapter. And finally, we have the components of credit risk management capacity and outlining key questions that the board of directors of a bank should ask. Now let's move on to the next chapter, CR4. It has been reordered. So most of the learning objectives, they are the same. Only one learning objective has been modified. The old learning objective was that the calculation of unexpected loss for a portfolio and the unexpected loss contribution of each asset. Now the same learning objective has been elaborated a little bit, and some specific portions have been highlighted over here, right? Like portfolio composition, asset characteristics, and size. Again, I'm saying that content for this chapter is 100% same. Okay. So learning objectives being modified means that there is a higher possibility that in the exam, this concept along with the specifics might be tested. Now let's come to this next chapter, CR5, which is again a new addition. So this chapter takes a lot of learning objectives from the old CR2 chapter. So the first one, the camel system, it was already there in old CR2. So it has been completely retained in this chapter. Then the second one, quantitative measurements and factors of credit risk. It was there in old CR1 completely as it is. Then capital as adequacy ratio. This is a new learning objective, but the content was there because if you explain the camel system, then capital adequacy is already covered. But yeah, the ratio has been calculated in detail. Then you have the fourth learning objective, judgmental approaches, empirical models, and financial models. This was partly in old CR4 because there was a learning objective in CR4 where we discuss the experts based approaches, statistical based models, and numerical approaches to predicting default. So it's quite similar, judgmental approaches, empirical models, and financial models. So we have tried to do proper research on the comparison of 2023 versus 2024 so that we can, even if suppose the language is changing, we are still able to understand and identify which learning objectives are being carried forward now. Okay, then we have the Merton model, which was there in old CR4. Then comparing and contrasting between Merton credit risk plus credit metrics and KMV. It was there in old CR5, which was credit risk and credit derivative chapters. And a new learning objective, which is RAROC. Now, RAROC also has been covered in detail in the context of operational risk, but it is being covered in the context of credit risk also this time. You have CR6, a new chapter, credit scoring and rating. And it is just before the other chapter, which is on credit scoring and credit retail risk management. So the second learning objective, through the cycle point in time, this is very similar to what we have done in part 1 in the valuation and risk models, one of the chapters. Then the process for developing credit risk scoring and rating models, and the rating assignment methodologies for issue and issuer ratings. Now the chapter name, the old CR4 chapter itself, the name was rating assignment methodologies, right? So over here, the old learning objective was describe rating agencies assignment methodologies, which is mentioned in white font. Describe rating agencies assignment methodologies for issue and issuer rating. That's it. Okay. But over here, it has been extended to identify the main criticisms of the credit rating agencies ratings. Okay, now this CR8 chapter is very similar, as I mentioned in the beginning, only to the contents of one of the chapters, VRM5 of FRM part 1. In fact, the chapter name is also the same, and this is from Ashwath Damodaran's book. So these are the learning objectives, which you can go through from the PDF directly. Then CR9 has been added, estimating default probabilities. I think this is from John C. Hull's book. This was previously in old CR4. So CR4 was a very important chapter, and since it has been removed this year, you will find that the learning objectives of many of the learning objectives of CR4 have been scattered across different chapters in the new 2024 curriculum. Then you have LDA, Z-score, and classification of firms by credit quality. Again, this was also in CR4. Third one also in CR4, borrower rating and probability of default. The fourth one, rating migration matrix, partly in CR4, right? So over here, you can see that there is a slight difference in the terminology. Mostly it's same, but there is just a slight difference. So that's why I've written partly in old CR4. Then you have hazard rate. and it has been used to define probability functions for default time as well as to calculate conditional and unconditional default probabilities. Now, there were two learning objectives in the old CR6 chapter. I think it was spread risk and default intensity models, right? That was the chapter name. So they have actually combined these two learning objectives into one. So hazard rate and uh, default time was there as one learning objective, and conditional and unconditional default probabilities was there as the another learning objective. They have combined these two learning objectives into one. Then recovery rates. This is also very similar to the content of old CR6. And this definition of CDS, explaining its mechanics and all, it was there partly in old CR5, where the learning objective was describing a credit derivative, credit default swaps, and total return swap. So again, I'm saying, if you see the new chapters which have been added, the candidates who are appearing for the exam, many of the candidates were quite worried actually when the curriculum was overhauled. They mentioned that they'll have to do the credit risk part once again. Some of them missed the passing score maybe by one or two questions, probably judging by their quartiles. So they don't need to worry that much because there are many learning objectives which are quite in line with whatever they have done earlier. Yes, they'll have to go through the entire course once again, but it will not be that they're covering it completely for the first time, right? It will be easier for them. And then this is a new one, CDS bond basis. This is very, very important. Next, we have comparison of default probabilities from historical data, comparison with the default probabilities calculated from credit yield spreads. Then we have the difference between real world and risk neutral default probabilities and determination of which one to use in the analysis of credit risk. Then this was exactly there in the old CR5 chapter, Merton model, valuation of the firm's debt and equity. And then using Merton model, it was partly in old CR4, distance to default. So again, I think this is a very uh, wise move, I'll say, to club these two learning objectives in a single chapter, because in CR4 earlier, Merton model was used to calculate distance to default. And then it has been introduced properly in the old CR5, right? Credit risk and credit derivatives chapter. So the sequence was not very good. But in this case, they have clubbed the two into a single chapter. So once you understand the Merton model, you'll be able to value the firm's debt and equity, and then you'll also be able to calculate the distance to default and default probability. And then you have to assess the quality of default probabilities produced by Merton, Moody's KMV, and Kamakura model. Then credit VR, one of the very important chapters which have been added, comparison of market VR with credit VR. Then definition and calculation of credit VR. I think earlier it was covered as only one or two learning objectives in some of the previous chapters. But this credit VR, the concept itself deserves a separate chapter in FRM Part 2 curriculum, which it has got this time. Then use of rating transition matrices for calculating credit VR. Check model to estimate capital requirements under the Basel II internal ratings based approach. Now, this learning objective also, CR10, the check model, it is quite similar to one of the learning objectives that we have covered in valuation and risk models. I think chapter 6, chapter 5 or 6, where capital requirements, I think it was chapter 6, measuring credit risk, right? So it was also related to credit risk only, and check model was used where we had the frequency of default, okay, which was modeled, and the number of defaults were modeled. So check model was used to combine them, and there were two distributions, if you remember. We had the Poisson distribution, and we had the log normal distribution. So frequency and severity were mapped, and check model was used to combine them to estimate the capital requirements. So yeah, that's what I mentioned partly in FRM Part 1, VRM 6. Then okay, this is also similar to one of the learning objectives in the same chapter, VRM 6, interpretation of check model. Basically, it was mostly about the interpretation of check model. Then credit risk plus and metrics has also been added. Then credit spread risk and impact on calculating credit VAR. It is partly covered in old CR6. Then we have portfolio credit risk. Again, this is a chapter which has been reordered. Okay, so only two learning objectives have been added and content is 100% same. There is no difference in the content. So there is already coverage in the 2023 curriculum with respect to these two learning objectives. And one learning objective has been deleted, which makes sense, right? Because now credit VR has a separate chapter. Okay, now this credit risk chapter has been added. So it covers some concepts of CR5 as well as CR6. And as I mentioned, that CVA has already been introduced before the 20th chapter, right? CVA has a separate chapter, but in this chapter, CR12, CVA has been already introduced. So as I said, I use the word probably, right? When I mentioned that this is an attempt to make the content more organized, redundancy has been eliminated to some extent, but I think there is still some level of redundancy even when you see ISDA master agreement later on. So there is some level of redundancy which is there, but I think overall the course has improved and gradually I think within the next 2-3 years, if there is any kind of change in the CR module once again, it will become even better. Then probability of default using credit spreads, it was partly in old CR6, which is the calculation of risk neutral default rates from spreads. Comparison and contrasting of credit risk mitigants and their role in analysis previously in old CR1. So it is not the case that the first three chapters or first 2-3 chapters of the new curriculum are just substitutes or they are covering the first few chapters of the old curriculum. No, if you see, even in CR12, one of the learning objectives of the old CR1 has been covered. So learning objectives are being scattered here and there depending upon which chapter or which concept they are most closely related to. Then we have the significance of estimating default correlation for portfolios and distinguish between reduced form and structural default correlation model. So it was there in old CR4 rating assignment methodologies, the difference between structural approaches and reduced form approaches to predicting default. Then Gaussian-Coppola model for time to default and calculation of probability of default using a one-factor model. Estimation of credit VAR using Gaussian-Coppola. Then you have another chapter, credit derivatives. This is also taking some of the learning objectives from CR5 because if you remember the name of the CR5 chapter itself was credit risk and credit derivatives. So some of the learning objectives have been covered in this chapter. So CDS, CDO, CDS again, then default probabilities to value as CDS, credit indices, fixed coupons, CDS forward, CDS options, CDS has been covered extensively over here. Then synthetic CDO valuation, two measures of implied correlation. One is compound correlation and base correlation. This, I think, has been introduced for the first time. Alternative approaches to estimate correlation. Then another chapter, as I mentioned, derivatives has been covered extensively. So one chapter, CR13, is for credit derivatives. This is for derivatives in general. And this is the chapter which I think there is some level of redundancy over here, which could have been avoided because some of the concepts are already covered in part one and some other chapters of part two also, right? So exchange traded derivatives and contrasting them with OTC. So we have covered this in FMP5, right? Exchanges and OTC markets in FRM part one. Then process of clearing. So all these things are there. In fact, there's a separate chapter also on clearing. Participants and describing the use of collateralization. So these things are there. So I think this is a chapter which gives you a foundational idea of everything. And then maybe the details have been discussed later on. So that might be the whole idea. Then defining the ISDA master agreement. This also is already present in one of the other chapters as well. So this is one chapter where some level of redundancy is there, but this chapter I think is there to make sure that you understand the basics of these concepts first, and then they'll be discussed in more detail. The features and use of credit derivatives, central clearing of OTC, and then CCB also has been discussed, margin requirements, SPVs, DPCs, CDPCs, and finally the approaches used and the challenges faced in modeling derivatives risk. Now, one chapter CR18 central clearing, this has also been added. If you remember, again in foundations, FRM part 1, financial markets and products, the sixth chapter, FMP 6, the chapter had the same name, right? Central clearing only. So most of the learning objectives are in line with whatever you have done in that chapter, and there'll be some extensions. Some more things will be covered. Loss waterfall is there, which was not there in FMP 6 earlier. Managing default of one or more members of CCP, bilateral central clearing, initial margin. All these margin concepts were also discussed. Cost of clearing was not discussed explicitly. Moral hazard is also there. Advantage, disadvantage already covered in FRM part 1. Then CR 21. Again, this is not a new chapter which has been added. This is a chapter where some learning objective, one of the learning objectives has been modified. So this was the old learning objective: stressed expected loss, stress loss on a loan portfolio, stress loss on a derivative portfolio. And this is the new learning objective, differentiating between. So basically the differentiating part has been added. Earlier it was only about calculation. Now it is also about differentiation between stressed expected loss and stress loss. So these terms are very similar, and the usage and the terminology seems to be very similar, but there is a subtle difference between stressed expected loss and stress loss. So that has been covered. Then you have CR 22, structured credit risk. In this chapter also, one learning objective has been added. Now, this is the chapter which has been pushed the farthest, right? Because it was earlier in CR 8, now it is in CR 22. One learning objective has been modified. Earlier, it was explained that added. This learning objective has been added. And again, content is 100% same, because there was a separate section where the cash flow determination was done, and it was mentioned that the custodian has to do these tests on the excess spread. Already it was discussed, right? So no change in the content. Fine. So this was all about credit risk. As we see that the goal definitely is to enhance the efficiency uh, of the material for students, or for that matter even practitioners or anybody else using the curriculum, right? But still there are some redundancies, some things which can be structured in a better way. Maybe it can be shortened a bit more. CVA, ISDA, some repetition of some theoretical chapters from part 1 in part 2. So there is still, despite the positive side of the reduction in the number of pages, there is still some scope for improvement in eliminating unnecessary repetition. Now let's come to operational risk. Now, operational risk, if you remember, it was already revamped in 2023. So not much changes in 2024, which means that the last year, the redesign that was happening, it has probably entered into a more mature and stable state now, and they are trying to build on the improvements which were made in the previous year. So I think then this gives a actually very positive message. It means that if there are minimal number of changes this year, that the FRM program is, at least based on the 2024 curriculum, is mostly aligned with the industry best practices and the evolution of the operational risk landscape overall in the financial sector. So no change in the content at all, and some minor modifications in learning objectives in OR4 and OR5. In OR4, one of the learning objectives has been added, which is based on factor-based models and Swiss cheese. And in OR5, two learning objectives has been added, different types of controls and control automation. One learning objective has been removed, but content is same. OR13, one learning objective has been modified. This is the old LO, and this is the new LO. So lessons learned from case study. So there was a very specific case study in the old LO. In the new LO, basically it is a more general learning objectives, just lessons learned from presented case studies. That's it. LR, nothing has changed. No modifications in learning objectives, no changes in content at all. Risk management and investment management, again, no change in content. And one learning objective has been removed from the 9th chapter, hedge funds. Which one? The characteristic of hedge funds and the hedge fund industry, and comparison of hedge funds with mutual funds. Because in part 1 also there is a separate section where fund management has been discussed. So that learning objective is already covered. Now, current issues. Let's first go through the list of deleted and added chapters. So CI, machine learning and AI for risk management deleted, artificial intelligence risk and governance deleted, inflation deleted, blockchain revolution decoding digital currencies deleted, future monetary system deleted. Okay, so we have 5 chapters being deleted, and these are the list of new chapters. Review of SVB failure, Credit Suisse case, AI and bank supervision this time, then responsible AI management, AI risk management framework, crypto ecosystem, and digital resilience. Okay, so basically, if you see, both years they have readings from the Basel Committee on Banking Supervision that address climate-related risk factors. So climate-related risk factors, if you see, these chapters are reordered. So climate-related 2 chapters which were there, they have been completely retained. Okay, in fact, 3 chapters they have been completely retained. So both of them are including these readings 2023 and 2024. And in 2023, we had a reading which was into machine learning and AI for risk management, which has been deleted, and inflation risk was there in 2023, which has been deleted. Okay. In 2024, they are specifically analyzing the recent bank failures, notably the Silicon Valley Bank and Credit Suisse. We all are aware of these big disastrous events, so that lessons can be drawn for financial regulation and changes can be made accordingly. Even in AI, some readings have been removed, but there have been many readings which have been introduced, some new readings which have been introduced, which provide a comprehensive coverage of AI in bank supervision, risk management, and frameworks, right? So these chapters are there, even though some AI related chapters have been removed, but AI and bank supervision is there, right? Then you have this artificial intelligence risk management framework is there, and digital resilience has been added. Digital resilience and financial stability, the quest for policy tools in the financial sector. Even the crypto ecosystem, one of the related chapters has been removed, but this CI9 chapter, the crypto ecosystem, key elements and risks, it has been added. So basically both the years 2022 and 2023 and 2024, they are addressing these common themes in current issues like AI, machine learning, climate related risks. The 2024 curriculum is trying to expand. Although inflation risk has been removed, it is trying to expand the scope of uh, uh, the current issues to include specific bank failure analysis, a digital resilience, as I said, and I think a deeper dive, if I may say, into the crypto ecosystem. Okay, so these are the learning objectives of current issues after this. Yeah, so we don't need to go through the learning objectives in detail because all the learning objectives are new since the chapters have been added. These all the learning objectives are new. So the PDFs that we had prepared for last year, they will be completely updated for the new chapters for this year also within the next few days only. And as I had mentioned, for current issues, no need to refer to the original papers. The PDFs that we provide is going to be more than enough, not only for current issues, but of course for uh, all the modules. The study material that we provide is going to be more than enough, and no need to refer to any other source for preparation. In fact, the feedback that we always get for our study material from our successful candidates is that when they were seeing exam questions, because part 2 questions are uh, highly, you can say, passage based excerpt questions, case study based questions, and when the candidates they were seeing the exam questions, they felt that these were excerpts directly taken from the study material that we had provided. And the study material is, as I said, enough to prepare. Nothing else is required. So, but the only thing that we advise is read the material completely, read between the lines. Do not miss anything uh, which you might feel is not very important. Okay, try and cover each and every part of the study material. So all the best, everyone. This was a very detailed video highlighting the changes. Of course, it was longer than expected as far as duration is there concerned. But I think it was important, especially for those candidates who are retaking the exam, because they'll be able to relate uh, the 2024 curriculum in a better way after watching this video. And the PDF of this, the content that we covered, will be made available, and the link will be posted in the description section only. So all the best to everyone. If there are any questions, please do let us know. You can always WhatsApp us or you can visit our website. And whether you enroll or don't opt for our study programs, anyone who's having any kind of doubt with respect to FRM Part 1 or Part 2 preparation, or even the prospects after the exam, they should definitely contact us, and we'll try to clarify their doubts as much as possible. So that's it for today's video. Thank you very much. Thank you. Bye. All the best.